Good morning, America, and good evening, India. You are watching the Policy Times exclusive show, US Capital Markets Update, July 2021, with Guru Sowle, financial advisor, Edward Zones. As the editor of the Policy Times, I'm extremely thrilled and excited and honored to welcome Guru to this show. This is an exclusive program where we discuss about the updates of the US capital market, what is the inflation rate, what is the impact of inflation in the United States and across the world, how is the emerging market functioning and working, what is the growth pattern in United States and also across other part of the world, and if you are an investor, then how do you see US capital market as a destination and what is the right time to invest? So just to give a quick recap, United States itself is a world in itself. What I mean that its size and magnitude is so gigantic that if you succeed in US, you can have a decent amount of share of wealth in the world. So just to give a couple of figures before I invite Guru to share further on this. In 2020, the US long-term fixed income issuance was $12.2 trillion, which increased by 48.1%. And the mortgage-backed security issuance increased by 96.2% to approximately $4 trillion. And the corporate bond market was 60% up in 2020 with $2.3 trillion valuation. Treasury securities was $3.9 trillion. I will straightly come to the equity issuance. For common and preferred shares, it was about $390 billion, which increased again 71% year on year, especially for 2020. So now, if I talk about the initial public offering, which is a hot cake, especially from the stock market point of view, the American IPO valued was around $85.3 billion, with 74% again increase over the previous year. So with this couple of facts and information, I want to invite Guru to kindly take us through the US capital markets update that has happened recently in July. In June.
Thank you, Akram. It's my pleasure to be on the Policy Times platform again. I know you're doing a great job hosting such discussions in other topics as well, day in and day out, and congratulations to the Policy Times. I am really excited to be a part of this activity that you're carrying out day in and day out. And from a capital markets perspective, it couldn't have been more exciting a time to discuss. And I know many of you in the audience are from India. It's already 9 p.m. there. Good evening to all of you. And good morning to everyone who's logged in from US, and maybe good afternoon to people in other parts of the world. This is a very defining moment in the economic history of US and rest of the world. So pandemic has changed the world. It has impacted the economy substantially, and we'll look at how it has impacted the economy. I know we have about 30 to 45 minutes for this discussion, and we'll try to keep the conversation within the time frame. Before we dive into the nuances of capital markets and economy, I must highlight one fact. What we're going through is not an economic crisis. It's not a recession. It's not a setback in a larger sense of the term. It is a health crisis. The difference between recession in 2008 and recession or so-called recession in 2020, 2021, now the driver is health and lack of health. Pandemic has impacted the world. So that has changed the dynamics completely. And I'll show you a little bit of information on how that has actually impacted the economy. And then we'll look at other parameters of interest and inflation and so on and so forth. So I'll have a few slides to share with you. It won't be a full-blown presentation, but I'd love to discuss with you on what's going on in the world today.
Sure.
So what's on the agenda today? The US economic growth will likely be slow, but will remain robust. And there's a context to what we mean by slow, and we'll talk about it in the next few minutes. We are looking at two key themes. One is inflation, and the other one is interest. And we'll also look at how is the globe responding to the pandemic, to Delta variant, what's happening to travel, etc. So as I mentioned earlier, the three key themes we'll be covering today:
Can
the
you increase
interest,
the
inflation, and
can you increase the size of the text? It's there in the sign you can see.
size of the text.
Right. So that we can
Let me check.
read it out. Yeah, the sign is there, plus and minus above.
Oh, okay. Yeah. Just a second.
Little bit so that we can read it out.
Yeah, sure.
You can continue the presentation.
Okay. So I was talking about the three key themes. One is the interest, inflation, and of course the consumer behavior. And overarching theme, of course, is how healthcare is impacting the economy. Right. Are you able to see the slide?
Yeah, go a little, make it little upward so that we can see.
Yeah.
Yeah.
So the markets today, the first half of 2021 is already over, right? There's extraordinary policy support that US government gave, almost a 1.7 trillion infusion into the economy that has changed a lot of dynamics in the economy. Almost $8 trillion liquidity pumped into the markets since the pandemic began, and that is substantial. So the Fed balance sheet is looking extremely, powerful now. But we still believe that there's plenty of room for the economy to continue to expand. Growth will likely be moderate, but will remain robust. And as the economy moves towards full reopening, we believe consumer demand will shift back from goods to much larger services sector. So what happened during pandemic was there was a tremendous demand for goods, and there was a big scare across the globe that we're going to run out of supplies, we're going to run out of tissue paper, for example, run out of groceries and food items, and we all started stocking it for a few months. But that is now shifted from goods to services. And when we say services, we're looking at travel, we're looking at entertainment and other services, including healthcare. So as far as travel is concerned, it's a significant economic indicator. US clocked in about 1.7 million passengers on 20th July this month. And that is just about pretty much about what we expected in the pandemic situation. 1.7 million passengers a day is a huge signal that travel industry is coming back. And that's also a big driver for economy to recover. And in 2019, around the same date, we were about 2.5 million passengers. So we're really not very far off from catching up with normal activity in the economy, at least in the United States. And another significant change that I wanted to talk about is from a US perspective, initially the economic recovery was led by the stimulus, right? Trillions of dollars being pumped in by the government, Fed buying bonds every month, billions of dollars of bonds. All that helped markets to be stable, markets to be growing despite the health scare, etc. But what is changing now is we're going to move a little away from stimulus-driven growth to jobs-driven growth. So in June, we clocked in about 850,000 jobs, and that is phenomenal. Today in America, there are more jobs than people wanting to take jobs. And we can talk a little more about that as we go along. 850,000 jobs just in June, and that's phenomenal. And what is significant about it is 40% of these jobs came from travel industry. So it signifies that the country is on the move. Travel is opening up. It may not open up 100%, but considering 40% of 850,000 jobs in June came from hospitality and travel, also is a big indicator for investment and investment strategies going forward. So recently, economic activity has risen at its fastest pace in the past 80 years. Expansion is expected to continue, but the rate of growth will naturally slow as GDP returns to its pre-crisis trend and fiscal stimulus wanes. So let's review how these developments have impacted the stock market. Now, the reason I wanted to share some of these high-level economic indicators is also because these have some profound implications on what's happening in the investment world, what's happening in the markets, and as investors, what should you be looking at when you're looking at US capital markets? And in some way, we'll also be touching the global capital markets and where the recovery is happening and so on and so forth.
Excellent.
So if you see this graph, I was talking about markets, are going to be a little modest in growth in 2021. So if you look at 20, US markets grew by 75%. Okay, March 9 to 10, it grew by 69%, and March 2 to 3, 2002 to 2003, it grew by 40%, and so on. So you will notice that every year there's been significant gains in the stock market, the following year has gained, but not at the same rate. So it's a clear indicator that 2021 is not going to be 75% growth in equities in the US stock markets. It's going to be modest. Quarter one, we clocked in 9%. Maybe we'll do a little more by the end of 2021, but it's not going to be anywhere at 75% that we saw in 2020. So millions of people made tremendous money in stock markets in 2020. Does it mean it's going to remain same? Absolutely not. So that is something that investors need to look for. So each year markets have gone up more than 20%. Following year has been slower than the previous year, and that is something to watch for. It's not a pessimistic message, but it's a very clear trend that we can depend on in devising our investment strategies. So the key point that's going to impact the next few months is inflation, right? So globally and in US, inflation has been spoken about substantially, and America is worried about inflation. Asian countries are worried about inflation, and we are looking at recording inflation rate of about 5 to 6%, perhaps even a little more than that. And what does that mean? Is inflation real? Is it temporary? Is it permanent? And should we worry about protecting the value of money as opposed to growing money as much as the market support? Right? So if you look at this yield curve, now the 10-year yield has been fluctuating. Okay, we've gone down from 1.7 to 1.2% recently, the 10-year yield on bonds. So if inflation was real, this yield curve would have looked very different in 2020. 2020-21, the yield would have been trying to catch up with inflation, but on the other hand, it's the 10-year projection is negative as of now as far as bonds are concerned. So which clearly means that inflation is temporary. So as investors, as financial advisors, we are really looking at inflation as a transition parameter, and we're not worried too much about investing or overweighting on fixed income instruments as opposed to equities. And if you look at some of the inflation statistics, unfortunately, I can't share the document here, but I'll be happy to take more questions one-on-one after this conference. Most of the inflation in America is in housing, in rental cars, in new cars, and in items that are really unconventional. The used car prices have gone up by 40% in US compared to 2020. So I was presenting in another conference last week, and my co-speaker was saying that your ideal investment strategy today should be equities, 80% equities and 20% used cars, right? So I'm saying that in a lighter vein because inflation is skewed as of today. The 90% of commodities are going to be stable, but inflation is kind of skewed because of the housing boom and hike in rental cars and used cars, etc. But all that is going to settle down in the next 6 months to 1 year as economy starts recovering. Inflation is going to settle down. So we're looking at about 5% inflation rate this year, and it is going to taper down to about 2 to 3% from the next year onwards. So we're expecting inflation to be back at 2 to 3%, at least in the US. So that's really not a permanent phenomenon for all those who are worried about inflation because of trillions of dollars that American government has pumped into the economy. That's not true, because there is a huge foundation that this economy has, and I'm going to talk about it in the next slide.
Excellent.
So where are the markets today? The global markets, right? So if you look at 2021, US and China are leading the recovery. Europe is lagging behind. It was still negative quarter one, but quarter two, we're expecting Europe to come back. And Asia has, minus China, Asia has had some issues coming back, but we don't expect that to last for too long. So US and China are leading this recovery here. And then you have some catch up from Europe in the next few quarters. And then at the end of 2021, we're expecting the GDP catch up by US, China, and US, China, and Europe to be on par. And what this clearly tells us from an investor perspective, the emerging markets are slow in recovery. There has been focus on whether it's mutual funds or ETFs or other securities. We were allocating a substantial, we were overweighting emerging markets, and that's something we need to look for, because emerging markets like South America, Asia, and some of the African countries may take some more time to recover because of the pandemic. But Europe is looking pretty good in the next 2 quarters. So US has upgraded guidance on Europe equities, and there's a substantial recommendation to take more exposure to international equities, especially the European markets, in the next 2 quarters. Right? And this is just a mega trend that we are seeing, and this is something that's dependable in terms of, if you're looking at a portfolio and you're looking at, okay, how much of international exposure you should take, we're probably looking at about 20 to 25% international exposure, specifically focused on European markets at this point in time. There might be some mix of emerging markets, but that's an opportunity that may be lagging behind, but it's not too far off, right? So, having said this, we're looking at the markets today, right? One key question could be, what should be, given the changing economic scenario and the pandemic scenario impacting economy, where should the investments go? Where should we overweight? And where should we underweight? The new highs and lows, volatility we discussed, are not signs of exhaustion. However, even the best of markets experience setbacks and shakeouts. Pullbacks are unavoidable, but they shouldn't be a reason to stay on the sidelines. And we are really looking at a bullish capital market in the next year or two. The reason is, even if Fed pulls back on its bond purchases, there's about $5.1 trillion in money market that's not invested. It's hardly making about 1%. And this does not include the CDs and bank deposits, etc. So America today has a cash of $17 trillion sitting on the sidelines, waiting to be invested. So what happens if Fed comes with a taper announcement on the bonds? If they stop buying bonds, what happens to the markets? These $17 trillion will start flowing to the market. So there's enough liquidity in the next 12 to 18 months in the US capital markets. So none of the analysts or economists or even Fed is looking at is really forecasting a lack of bull run, or nor are they looking at it in a pessimistic manner. So the key message here is, it's a good time to take risk, stay invested in equities. It doesn't mean markets are going to be stable. They're going to be volatile. It's going to be a bumpy ride, but but volatility can be handled, okay, because we have a good handle on what's happening with inflation and what's happening with interest rates. So if we can manage those two parameters, we should be able to handle volatility. And if we can navigate our investment strategies around volatile markets, you will still see a very positive turn to equities in the US markets. And to a certain extent, we're also bullish about European markets. And in every portfolio that we craft in the US, we allocate some part of the investment to emerging markets like South America, India, China, Japan, etc. So there's a healthy mix. So my message today is we are looking at a good bull run, positive run for the next 12 to 18 months. It will be volatile. You will have temporary setbacks, but don't worry about it. Since 1971, S&P 500 has experienced a 5% or greater pullback about every 4 months. So every 4 months, S&P drops with a median decline of 9.4%, right? So the last sizable decline was in September 2020 when stocks fell 9.6%. So we might be due for a correction now, but that really doesn't worry analysts and advisors like us, because we are seeing an opportunity here, an opportunity for asset allocation. And if you look at our guidance, it clearly shows, if you look at this graph, it says you can overweight international and mid-cap stocks. You can also overweight emerging markets. So what does this mean? It means whenever there's a global economic recovery happening, as a trend, the emerging markets and markets outside US recover before US recovers. So, which is why there's an investment opportunity in emerging markets and other markets internationally. So we're watching them closely. So to take a early position in those markets, our recommendation is overweight on international, overweight on emerging, and overweight on small and mid-cap stocks, and also value stocks. There's going to be a growth play as well, but there's going to be a balance between growth and value. So if you look at this, a summary of the investment strategy, it very clearly says today, when we are looking at crafting a portfolio, we are taking enough cognizance of the fact that international markets have to be at least about 20 to 25% of the overall portfolio. And that's something that I wanted to share today. And we might go a little underweight on US large cap stocks and US and international large cap stocks. International value, international mid cap is going to play very well. And we're also going to go a little underweight on international bonds. Okay? And I know some of these may be a little abstract to you, and I'm happy to take questions. Because the compliance reason, I can't take questions on individual stocks or securities in this conference, but I'll be happy to share my contact details, and you can reach out to me if you want to have a one-on-one discussion on anything that's happening in the markets, or if you want to get some investment guidance. I'll be happy to share that with you.
Excellent.
So, thank you, Akram. And so I'll just wrap up with another message. So we spoke about overweighting on international and underweighting on US growth a little bit at this time. But most importantly, you will want to ensure proper diversification. So at no point in time in the investment journey, there is a set formula. There's no magic wand. There are no guarantees for returns. And usually investment is about managing risk and not as much about projecting a return and achieving that number, which never happens, right? So you'll want to ensure proper diversification and proper allocation. And your comfort with risk is really very important, while maintaining realistic expectations for volatility and returns. So this can help keep you on track through the rest of the year and beyond. Keep in mind that diversification doesn't ensure a profit or protect against loss in a declining market. At the same time, it is a great hedge against risk. So what we do at Edward Jones is we help millions of investors review their portfolios, and you don't need to be a client to take a second opinion or assess your portfolio. It could be your retirement accounts, it could be your brokerage accounts. We're happy to review your portfolio and give you guidance, no obligations. And you're more than welcome to reach out to me if you want to kind of get some more insight into what's happening with your individual portfolios. And having said that, I will wrap up this part of the presentation and with a note signing off that markets are going to be dynamic. They will be uncertain, but as long as we benchmark our individual investments against global economy, against individual national economies that we are in, I think we'll be navigating our investment journey with a good footprint and with a good navigation tool. And so thank you so much, Kram, for this opportunity. I'll pause here if there are any questions. I'm happy to take questions. As I said, I won't be able to react on individual securities, but if there are any broad trends that anyone in the audience wants to discuss, I'm happy to discuss.
Absolutely. Thank you, Guru, for giving overall architecture about the US economy. You touched upon how the stimulus has boosted the economy, followed by, again, massive amount of jobs which has been created. The inflation has been at 5% now, but you are quite optimistic that this will be at around 2% going forward. And then the final point, you said that you have around $15 trillion cash to be invested in the market, which is yeah, sorry, please unmute yourself. Yeah. So that means there's a huge amount of investment waiting in the economy.
17 trillion.
Yeah. $17 trillion cash, which is a huge, humongous amount. Right. And then finally, you concluded with the how US market is a good destination for investment. So with this, I would invite some of our participants if you would like to ask any question. So Guru would be very happy to take those. So Professor, would you like to ask any question? Or anyone would like to ask any question?
Yes, Guru. Can you hear me?
Yeah, yes, please. Yeah.
Okay. Having said all those, the reasons, the data that you have displayed, the pros and cons and all the excitement. So can I say that you're suggesting that it is an exciting time to invest in the US, despite the fact that you and I know that, with all this global pandemic right. and with all this uncertainty and this, every night before I sleep, I'll be watching next door, what you call Bloomberg. So I get latest details or updates on what's going on in the market. So right. With all this, I'm worried. It's not that I'm an investor, but I used to be in National Equity Corporation of my country, of Malaysia. So I know, a little bit about in investment, and what you call, especially the relationship between US and China, with all this heightened, what you call, very subtle intimidation. Do you think that's okay? I mean, investment wise.
Yeah. No, that's a good question, and you also touched upon US-China situation, and yes. That's a very interesting dimension as well. Thank you for the question. It's a great question. So if you're looking at US markets today, as I said, after pandemic started, the Fed started backing the economy substantially. And if you go back to my earlier message, we know it's not an economic crisis; it's a health crisis. Yes. So if you have 75% of the US population vaccinated, the economy is back. So it's not like 2008 when economy crashed, right? All the markets tanked 30% in 2020 March. We came back up more than 100% by December 2020. It happened because government supported. There was a huge trillions of dollars of infusion of cash. The Fed is still buying bonds, about 200 billion every month, and so it didn't let markets, go slow, or they didn't let market sentiment to dilute. Having said that, the only concern for any investor would be to say, what if Fed stops buying bonds after December, for example, right? Now, that's when I mentioned that, there's this $5.1 trillion sitting in money market, which is not invested. It's not even making 1%. And you have another $12 trillion sitting in bank deposits and CDs and other assets. So as bond purchases taper off from the Fed, this $17 trillion is going to find its way into capital markets in the US. So we don't expect the markets to really collapse or anything significantly changing on the downside after Fed stops supporting. And the Fed will stop supporting because the Fed has to ensure that US economy is standing on its own, and whenever it had to intervene, it intervened. So we're looking at 2022, 2023 when markets will hold on their own, and that's probably what we're really looking at. So if you're asking whether it's a good time to invest, from an equity standpoint, it's going to be positive, but don't expect 2020 to repeat. We're not going to gain 75%. We may gain maybe 10, 20%. But at the same time, the positive outlook cannot be ignored. And there's an opportunity. There's an opportunity. If you also ask me, if I extend your question and say, what are the key trends we're looking at going forward, right? So we're looking at semiconductor industry, the chips, the huge chip shortage. Okay, there's almost a $3,000 component of chip in an average vehicle in the US. Okay, there's a supply chain issue. Chips are not available. There's opportunity in genomics, in immunology, and there's green revolution happening. So there's so much that's changing in the economy, the new investment opportunities that are emerging. And I was watching CNBC this morning. Robinhood went public, and the vision of Robinhood is to democratize investments and democratize finance, and I think they've been greatly successful. So does it mean it's a positive sign? Absolutely. I think it's a good time to look at, and obviously, whenever you plan to invest in US, or whenever you decide whatever you want to do, definitely look at your own risk, your risk score, and if you're willing, I can help you create your risk framework. We have a tool where we assign a risk score for each individual. Based on that, you can decide, devise your investment strategy. So we can do all of that. As far as US-China is concerned, I was watching CNBC yesterday. The CEO of Boeing, David Calhoun, was talking. And, Boeing, one of the biggest markets for Boeing is China. Okay, what if China stops buying planes from US, from Boeing, right?
Boeing is, I watched that too, but Boeing is now going to Mars and Jupiter with their new partners. I'm sure you're aware of that.
So Boeing has a space plan, which in fact the CEO announced yesterday. We can talk about that offline, but the point I'm trying to make is Boeing is already talking to China at a very different level. So I think the political impact, the pandemic impact, and the economic collaboration are going to be, this is just my view, there's going to be some compartmentalization. But I think on the whole, as far as the economy is concerned, I think all these countries at some stage will establish a point of convergence. So we're really not seeing much apprehension in being able to invest in US capital markets, whether you're in US or outside US. I think it's a good market to evaluate.
Thank you, Guru. But I'm don't get me wrong. I'm asking the question for all the rich fellows, who are listening and watching. I don't have, the only thing I have are all the books behind me and asking
Sure.
you the questions. All right, thank
That
you,
is
Guru.
awesome.
Back to you, Akram.
Thank you, Prof, for asking this nice question. So, anyone else in our participant list who would like to ask question? Chartered Accountant Ashok Gargji, would you like to ask any question? Or anyone else, if you have, you're most welcome to ask. So, I'll come back to Guru, maybe. So, you're welcome if you want to ask any question. Guru, that means what you indicated in the end is that the next level of Amazon or Tesla, we are going to see from the sectors you just mentioned. And those can be the next portfolios that you are indicating, right?
Oh, yeah. Those are sectors to closely watch, especially the medical devices, semiconductor industry, genomics, immunology. BlackRock, which is the largest asset manager in the world, they manage about $9 trillion in assets. They're predicting that the next Apple or Amazon will come from immunology or genomics. And that's a sector to watch. And there's a lot happening. There are exchange traded funds, there are mutual funds, there are stocks, there are other securities from these sectors that investors can and maybe should definitely evaluate to be positioned for the future. So what we usually do is when we advise our clients on investments, it's not about how much we made last year and continuing with the same portfolio. It is about preparing and positioning your portfolio for the future. It's about positioning your portfolio against the economic trends that are going to emerge in the next 12 months, 18 months, 24 months. So as long as your portfolio is benchmarked against the future, you're running very little risk. There's still risk. There's always a risk. But as long as you know what that risk is and you're managing the risk, your navigation is on track. So that's what we kind of advise most of our clients.
Guru, my final question maybe of the evening.
Yeah.
Is a lot of research says that Chinese companies or Chinese investors have taken very good advantage, or they have leveraged the America is a global market, right? The whole
Right.
world will reach out to America, invest and benefit from this. Chinese have done pretty well. Considering from the Indian perspective, how do you see Indian companies and Indian investors, big investors, can leverage the American market?
Sure. Great question, Akram. A couple of years back, I was working with a few investment banks, and most of these principals and managing directors and partners, every time I call, they would say that they're in China and they didn't have the time to meet. Okay, and that's on the positive side. They were doing a lot of business in China, bringing Chinese companies into the US for listing, right? And that is a great trend. And China, like in all other areas, have been extremely sharp in leveraging US capital markets. There are hundreds and hundreds of Chinese companies that get listed on NASDAQ and NYSE. Even with all that's going on in 2020, 21 in the politics, in healthcare, China is still kind of a dominant player in the US capital markets. And they've had some very, very successful IPOs, including Baba and several other Chinese companies. From an Indian perspective, I think this is just my view. And again, since I had my initial career in India as well, I can relate to it. There are thousands of Indian companies that can leverage US capital markets. There are avenues for Indian companies to get listed in US stock exchange and raise capital, establish US currency for their own company. I think there's a great opportunity. There are very, very few Indian companies like Infosys who have leveraged that. But I must also share this offline, that there are several pre-revenue companies that can potentially get listed on US stock exchange. And I think American capital markets are very, very open to foreign companies, including Indian companies, as long as they check all the boxes on what does it take for a Indian company to get listed. There are opportunities that one can leverage. Does it answer your question, Akram?
Yeah, absolutely. Thank you, Guru, for answering this.
Do you have time for one more question?
Yes, please. Go ahead.
Please go.
Yes, sir. Sir, I mean, the way I look at it is the financial system requires daily intervention from the central banks. Do you think this is sustainable over time? Because when you're talking about Tesla, the PBI right now, as of today, is around what, 360 something? I mean, if you're talking about a stock to invest when the PBI is around 360, and I mean, Amazon, yeah, I mean, it burned the cash of billions of dollars over the years. And it was at the right place at the right moment of time at the very beginning of the internet, the e-commerce and all that stuff. I don't think Amazon will let another Amazon to emerge in that same sector because it has a virtual monopoly. And I mean, do you think it's a stable system? I mean, is it going to survive the next 2 decades? The finance system right now, as we are in, central banks putting 200 billion a month, not only just Fed, everywhere, ECB, Japanese, Chinese, Indian.
Sure. No, I think there's a context to it. It's a great question, but there's a context to it. So the Fed did not say that they will permanently support markets or they will permanently keep buying bonds. Okay, it is going to taper off, and we are actually expecting a taper announcement anytime in the next few months, and the support system will change, substantially. Now, as far as Teslas and Amazons are concerned, as I mentioned, I won't be able to comment on individual securities because of compliance reasons. When I said that the next Amazon or Google may be coming from genomics or immunologies, that was more of an analogy, not as much a direct reference to the securities. So the support is temporary. It is transient. It is because the pandemic made a huge impact because we are facing a healthcare war. The US government intervened, and I think the plan for Fed in the next 1 or 2 years is going to be to kind of taper off on the bond purchases and have economy stand on its own and let that liquidity of 17 trillion flow back into the market, by which time we are also anticipating the emerging markets, the Asian markets, the European markets to come back and adjust in the overall economic equation. So we are really not expecting permanent, non-stop support. That's not going to happen.
Excellent. Thank you, Guru. So I think with this we have to come to the end of the show. So what I understood from the presentation of US capital markets that you made, Guru, is that US is already back on track with a very strong foot, whether it is through stimulus and now boosting the economy, pumping a lot of money into infrastructure, and I think also on many other sectors. So this, again, US is becoming a good and potential market for global investors. So Guru, any last comment and then...
Hi Guru, this is Anjan. Can you hear me, Guru?
Hello Anjan, yeah, good to see you here.
Yeah.
Go ahead.
Yeah, I'm from Mumbai. Guru, this my question that how this exchange fluctuation risk of several emerging countries vis-a-vis dollar will impact the emerging market countries as far as stock markets are concerned. This is one. Secondly, my worry is this is a liquidity driven market, as you explained to us. Only liquidity driven market can sustain for a long, or some fundamentals need to support this market.
Correct. Good question, Anjan. On the exchange situation, we're watching it closely. I think US dollar is likely to weaken in the next 6 to 12 months. That is a projection. Right now, it's a bit it's a bit strong because emerging markets had a setback because of Delta variant. Okay, and because Delta variant is also coming to the US, we don't know the exact time frame in which exchange rates are going to get impacted, but we are projecting projecting the dollar to weaken in the next few months. That's what economists and experts are saying. And what will happen is when dollar weakens, there's going to be a corresponding impact on the emerging markets. As far as liquidity is concerned, as I said earlier, US of course was in a strong position to bring in that kind of liquidity. So which is why in one of the slides I showed that US and China are leading the recovery, and Asian markets are lagging behind. That's also the reason why we are seeing a delayed global recovery. But emerging markets will come back. Markets like India, Japan, Brazil, and some African countries as well. There's going to be, as a pandemic slows down and as more people get vaccinated. Another important point is the supply chain. Okay, I think India particularly is in a very good position to support the supply chain situation globally, both technology-wise as well as logistics-wise. So supply chain is also going to drive the recovery, and the more focus on supply chain and focus on these sectors, like if the countries that are going to address chip shortage and those kind of things, I think the recovery is going to start from there. But we are expecting some exchange fluctuations to impact the global economy very, very soon. Yeah.
Great. Okay. Any more surprising question or surprise question? I think excellent presentation, Guru, and excellent analysis. I think we had a very nice view about the US capital market. So viewers, if you like, Guru would like to add anything in the end? We'll
no, only thing I would like to add is if anyone wants to discuss further, if you need any specific inputs on any investment guidance, or if you want to review your portfolios, feel free to reach out to me. Akram has my email and phone number, and I'm happy to help. To me, I'm, as I said, I'm a financial advisor, Edward Jones. We manage about $1.2 trillion in assets. We have about 7 million clients in the US, and we also have some international clients. And so you're more than welcome to reach out to me, especially, all of you from India. I have a emotional connect, so happy to help anytime.
Thank you.
Thank you, Akram, for this opportunity.
Thank you so much, Guru. Viewers, keep watching the Policy Times. If you keep watching this show, we will be doing a show in every fortnight where we will bring different experts from US market who will share how and how to analyze US market and how is the US economy working. And thank you. Keep watching the Policy Times.
Thank you all for watching and have a good night.